Hello, this is Brian Shannon from Alpha Trends Blogspot. It is Tuesday, the 11th of December, 2007, and the market has closed. The Fed spoke, and the market didn't like what it heard today. The S&P 500 finished with a loss of $3.88, or about 2.5%. And you can see that this recent rally that we've seen has now pretty much almost completely failed, as the market was rising on decreasing volume, showing that the conviction wasn't really there from the buyers, maybe more of an absence of supply. And today that supply came back into the market in force. Now it looks like potentially it's going to hold, look to hold, that is, near this 10 and the 200-day moving average. But again, we do have the declining 50-day moving average, and as long as the 50-day moving average is declining, generally you want to be skeptical of any upside movement in the market. So when we look at the 10-minute time frame, for instance, we can see here that today's sell-off was pretty severe here. As you can, let's just see it. For some reason, it doesn't always update properly. But here we are, taking a look at the 10-minute time frame, and you can see from the most recent leg higher, it did give back more than 2/3 of that. So that's what's considered to be a failed move. It is back below the 5-day moving average. The 5-day moving average is flattened out, and we've got this very big volume in here. So there was a real rush to the exits today, a real panic on the in what we saw from today's activity. If we take a look at the bigger picture move of the recent rally from the just about Thanksgiving lows up till the recent high, it's can't come in so far 2/3 retracement. So I'm going to reiterate that basically this is a short-term trader's market. I've been saying that consistently for months, and I said that I expect that'll probably continue to be the message. It remains a short-term trader's market, and that's where the opportunity is. If you come into this market locked into a belief, either bullish or bearish, you're just going to get chopped up in here. If that opinion is something that you're trying to implement to the market on a time frame more than let's say a couple weeks or so, because it's just been a very, very choppy year. And overall, when you look at the weekly time frame, it's still painting a negative picture. We can look at this as, if the market doesn't get back above this level, then we've got a lower high, and a lower high doesn't mean the market is going to go continue down. But if it breaks down through support and we get a lower low, I think that the video that I did about 2-3 weeks ago about a longer-term view of the S&P 500, we could see the potential for a longer-term bear market unfold. But you can't get all bearish after one day's big sell-off. You have to listen to the message of the market. Maybe we see a bounce back up towards 150. See how the market acts around there. But basically, when you have a big emotional day in the market like you have today, it's best to just kind of take it slow the next few days, let the market settle down, and provide you with a better low-risk entry point. Because after a sell-off like we see here, is not the best time to be looking for an entry on the short side. And definitely, anyone who bought in here today, almost every single person that bought the S&P 500 today and is still holding it at the end of the day, almost every single one of them is losing money today. So it remains a tricky environment, especially for investors. If you're a short-term trader, then it's a fantastic environment to be involved in. Let's take a look at the semiconductors. Semiconductors are back down to what's been an important level, right around this 420 level area. So they didn't come down as hard actually as the rest of the market. When you look at a Fibonacci of the recent activity here on a 10-minute time frame, it only retraced rather 50% of that move from the most recent leg higher. So semiconductors are acting a little bit stronger than the rest of the overall market. I think breaking back below, let's just call it this low here, breaking back below 419 and taking that 2/3 retracement out, then we probably go down and test these lows. That's the path of least resistance anyways. So we've got again, mixed messages from mixed markets and different time frames. The IWM, the Russell 2000, if we take a look at the bigger picture sell-off, it came up to about a 50% retracement of that much bigger decline here. It retraced just a little bit more than 50%. Also came in and found resistance right at that declining 50-day moving average. That's where the market found its resistance after rallying again on light volume. When you see a light volume rally, you can still trade it to the upside because the only thing that pays is price, but it does mean be suspicious that that market can hold on to the rally on light volume because the conviction from the buyers just isn't there. In particular, when you do have other technical evidence like a declining 50 and a declining 200-day moving average, it says there's a much bigger, more negative picture here. And again, that 73 level is going to be very important here over the next few months. Breaking below that, then much bigger problems could unfold for this market. As far as if we take a look at the action on a Fibonacci from this recent low here, you can see that the market came down a little bit more than that 2/3 retracement. There's potential for maybe the market finding support near that 75.5 level. That was important. If you remember, that's this area where we had seen the market really break down 75.5 to really 75.75. I think though that the 75.75, 75.80 was this level in here. It broke that level and then it hopped back up above it, trapping these bears in here. So this rally now is in jeopardy of failing, and if it does fail, then I think you're going to look at the test of that $73 level coming in fairly short order after that. But as hard as it sold off today, I wouldn't be surprised to see maybe a little bit of a bounce in here as people kind of reevaluate why they were throwing stocks away so aggressively today. But there remains a lot of risk in this market. The risk has been absorbed by the bears over the last week. Now it's the bulls' turn once again to take the brunt of the risk in here, and that's again why it remains a fantastic environment for short-term trading. That's the picture that this market is sending us. When we take a look at the highs that the market saw to the recent lows, you can see that it came right up to that 2/3 retracement, and that's where it found some selling. Again, it's obvious to look at this diminished volume on this rally. It's a very clear sign that the conviction just wasn't there from the buyers. It was just a lack of supply on the way up, but the supply comes in all at once just based on a change of perception, and that change of perception was caused by the Fed announcement and then further exacerbated by breakdown in technical levels. And it appeared that a couple days above that 50-day moving average wasn't enough to hold it, and also this level of prior support, which we had been monitoring, and it held 2 days above that. 52 was going to continue to be a very important level of potential resistance going forward. And I think if you're looking for a short sale opportunity, that there might be a good chance to do that if we can get a bounce up towards 52, not sell it on the strength up towards that level, but wait for the sellers to reemerge and take back control of the market and see a failure of that 52. From there, I think then it makes sense to position yourself on the short side in the Nasdaq, and probably the best way to do that is with the QID, the double inverse Qs. So again, it remains a very risky environment. And if you're not honoring stops, it's going to end up hurting you. If you're trying to catch the bottom, catching bottoms, again, it's the hardest job on Wall Street. I've never met anyone who can do it with any consistency at all.